My grandmother paid utility bills she didn't legally have to pay for 11 years. 11. She was 73 when she found out. The total she overpaid? Just over $8,400. And when I started digging into this, I realized it's not just utilities. There are entire categories of bills that millions of Americans, especially seniors, are exempt from, and they have no idea. Today, I'm breaking down 5 bills you should stop paying in 2026 if you qualify, plus 4 bonus tricks that could save you thousands. And I promise at least 2 of these will surprise you. Some of these apply even if you're not a senior yet, so don't click away thinking this is only for your parents or grandparents. You're going to want to know these. All right, bill number 1, property tax exemptions. Now, before you skip ahead thinking this doesn't apply to you, hear me out. Most states offer what's called a homestead exemption. And if you're over 65, the savings can be massive. In Texas, for example, seniors get an additional $10,000 off their home's taxable value on top of the standard exemption. In Florida, some counties offer complete property tax freezes once you hit 65. But here's the thing, you have to apply for these. They don't happen automatically. My friend's dad in Arizona was paying full property taxes at 68 because he assumed the county would just know his age. They didn't. He applied retroactively and got a $2,100 refund check 6 weeks later. Now let me put this in perspective for you. The median property tax in the U.S. is about $2,400 per year. If you're a senior in a state with generous exemptions, you could be cutting that by 30, 40, sometimes 50%. In New Jersey, which has some of the highest property taxes in the country, seniors can get deductions of up to $250 off their tax bill just for being over 65. That might not sound like much, but compounded over 10 years, that's $2,500 you kept in your pocket instead of sending to the government. The application usually takes 10 minutes online. Search your state senior property tax exemption and you'll find the form. Some states require you to be the primary resident. Some require you to have lived there for a certain number of years. Some have income caps, but the point is you won't know unless you look. If you're not a senior yet, send this to your parents. They'll thank you later. And if you are a senior and you're watching this right now, pause the video and check. Seriously, I'll wait. Because that 10 minutes could be worth hundreds or thousands of dollars. Bill number 2, certain Medicare premiums and prescription costs. Now, I'm not saying stop paying Medicare entirely, that would be stupid. But if your income drops in retirement, which it usually does, you might qualify for programs that eliminate or drastically reduce your Part B premiums and drug costs. There's something called the Medicare Savings Program. And if you qualify, your state pays your Part B premiums. That's $185 a month in 2026, completely covered. Over a year, that's $2,220 that stays in your bank account instead of going to Medicare. Then there's extra help for prescription drugs, which can cut your medication costs by about $5,000 per year. The income threshold for a single person is roughly $22,000 a year. For a married couple, it's about $30,000. Most retirees don't even check because they assume they make too much. But if you're living on Social Security alone, which averages about $1,900 a month, you probably qualify. Here's where it gets interesting. Social Security income counts toward these limits, but not all of it. Only about half of your Social Security benefits are counted in the income calculation for these programs. That means you could be receiving $24,000 a year in Social Security and still qualify because only $12,000 of it counts toward the limit. Most people don't know this. Most accountants don't even mention it unless you ask specifically. The application is at ssa.gov. It takes 15 minutes. I've linked the direct page below. But here's a pro tip. Apply even if you think you might not qualify. The worst thing that happens is they say no. The best thing? You just saved yourself $2,000 plus a year. I've talked to people who were $500 over the income limit and still got approved because the Social Security counting rule worked in their favor. You literally have nothing to lose by trying. Bill number 3, student loans. Wait, I know what you're thinking. I'm 65. Why do I still have student loans? Here's a stat that blew my mind. Over 3.5 million Americans over 60 are still paying student debt. Some of it is their own. A lot of it is Parent Plus loans they took out for their kids. If you're on a fixed income in retirement, you might qualify for an income-driven repayment plan that drops your monthly payment to $0. Legally, zero. Let me explain how this works. The government calculates your payment as a percentage of your discretionary income. Discretionary income is basically your adjusted gross income minus 150% of the federal poverty guideline for your family size. In 2026, for a single person, 150% of the poverty guideline is roughly $22,000. So if your adjusted gross income is $25,000, your discretionary income is $3,000. Your payment is 10% of that divided by 12. That's $25 a month. But if your income is below that $22,000 threshold, your discretionary income is zero, and 10% of zero is zero. Your required payment is $0. It doesn't mean the loan is forgiven immediately, though after 20 to 25 years on these plans, the remaining balance is. But it does mean you stop sending them money every month. Call your loan servicer and ask specifically about income-driven repayment and total and permanent disability discharge if you have any qualifying medical conditions. Don't let them steer you toward forbearance. That's a trap that keeps the interest running. Forbearance is what they push because it's easy for them. Income-driven repayment is what you want because it actually solves the problem. And here's something else most people don't know. If you're on Social Security Disability Insurance, or SSDI, you automatically qualify for a discharge of your federal student loans if you meet certain criteria. You don't even have to apply for income-driven repayment. You apply for a total and permanent disability discharge, and if approved, your loans are gone. Not deferred, gone. The application is at disabilitydischarge.com. It's run by the Department of Education. If you or someone you know is on SSDI, this is a must check. Bill number 4, certain utility fees and state telecom taxes. This one is weirdly hidden. In about 22 states, there are programs that exempt low-income seniors from specific utility charges. Things like infrastructure fees, 911 service fees, and state telecom taxes on landlines or basic cell service. In California, the California Lifeline program gives qualifying seniors up to $39 off their phone bill every month. That's $468 a year for a phone you probably already have. In New York, the Elderly Pharmaceutical Insurance Coverage Program, EPIC, also has a utility discount component for qualifying seniors that most people miss because the name makes it sound like it's only for drugs. In Illinois, the Low-Income Home Energy Assistance Program, or LIHEAP, can cover up to $1,000 of your heating and cooling costs per year if you qualify. In Pennsylvania, seniors can get a rebate of up to $650 on property taxes and rent. But they also have a separate program for utility bill assistance that caps your energy costs at a percentage of your income. The trick here is that these programs are buried in state government websites with terrible navigation. You have to dig. Search Senior Utility Discount or call your utility company's customer service and literally ask, do you have any senior or low-income discount programs? Most reps won't mention it unless you ask directly. I've actually tested this. I called 5 utility companies posing as a senior and asked about my bill. None of them mentioned discount programs until I specifically asked. Then suddenly, oh yes, we do have the Senior Citizen Discount Program. Would you like an application? It's like they have a script that only triggers when you say the magic words. Bill number 5, Required Minimum Distributions Penalties. Okay, this isn't a bill you pay monthly, but it's a tax penalty that costs seniors billions every year. Once you hit 73, you have to start taking money out of your traditional 401k or IRA. It's called a required minimum distribution, or RMD. If you don't take it, the penalty is 25% of what you should have withdrawn. That's not a typo, 25%. So let's say you have $500,000 in a traditional IRA, and your RMD for the year is $18,750. If you forget to take it, or you don't know you have to, the penalty is $4,687 for doing nothing, for leaving your money alone. That's more than most people's monthly Social Security check. But here's what most people don't know. If you're still working past 73 and you don't own more than 5% of the company, you can delay RMDs from your current employer's 401k indefinitely. No penalty, no withdrawal. Your money keeps growing tax deferred. This is huge. Let's say you work until 80. That's 7 years of RMDs you don't have to take from that specific 401k. At an average RMD of $20,000 per year, that's $140,000 that stays invested instead of being forced out. If that money grows at 7% annually during those 7 years, you're looking at nearly $200,000 in additional wealth just from knowing this one rule. Also, if you forget to take your RMD and it's your first time, the IRS will often waive the penalty if you correct it quickly and write a reasonable cause letter. The key word is reasonable cause. You can't just say I forgot. You need to explain the circumstances. Maybe you were dealing with a medical issue. Maybe there was a family emergency. Maybe you genuinely didn't know because you just turned 73. The IRS actually grants these waivers pretty frequently for first-time offenders who act in good faith. I've seen people save $10,000 plus in penalties just by knowing this rule and acting fast. The point is, RMD rules are complex, but the penalties are brutal. Know the rules or they become a very expensive bill. All right, 4 bonus tricks that aren't technically bills, but function exactly like them. Bonus 1, stop overpaying for Medigap. Once you're in Medicare, you need supplemental insurance. But here's the catch. Medigap plans with identical coverage can vary in price by hundreds of dollars per month depending on the insurer. A Plan G is a Plan G is a Plan G. The benefits are standardized by the government. Company A might charge $140 a month and Company B charges $280 for the exact same coverage. Shop it every year during open enrollment. Use Medicare.gov's Plan Finder. I watched my uncle switch from a $267 Plan G to a $148 Plan G with identical benefits. That's $1,428 a year for the same product. Over 10 years, assuming modest rate increases, that's probably $15,000 to $18,000 in savings for the exact same coverage. The only difference was the logo on the insurance card. And here's the kicker. You can switch Medigap plans during your 6-month Medigap open enrollment period when you first sign up for Medicare Part B. After that, insurers can deny you or charge you more based on health conditions. So if you're newly eligible, shop aggressively during that window. It's your one chance to get the best rate without medical underwriting. Bonus 2, the Social Security Tax Torpedo. If you're working while taking Social Security before your full retirement age, your benefits get reduced if you earn too much. In 2026, that threshold is roughly $23,400. For every $2 you earn above that, Social Security withholds $1 of your benefits. It's not technically lost forever. You get it back later through higher payments once you reach full retirement age, but it's cash flow you don't have now. And cash flow matters, especially if you're relying on that money for monthly expenses. If you're close to that threshold, structure your income. Work a little less, defer some freelance payments, or push a bonus into the next tax year. If you're self-employed, you have even more flexibility. You can choose when to invoice clients, when to recognize revenue, when to take distributions from your business. The point is, know where the cliff is before you drive off it. I know someone who earned $24,500 one year, just $1,100 over the limit, and lost $550 in Social Security benefits for an extra $1,100 in income. That's a 50% effective tax rate on that last $1,100. Brutal. Bonus 3, property tax appeals. Even if you don't qualify for a senior exemption, almost everyone can appeal their property tax assessment. In most counties, assessments are automated and inflated. The county looks at what homes sold for in your area, applies a formula, and sends you a number. They don't look at your specific home's condition. They don't know you have a cracked foundation or an outdated kitchen. They just see square footage and location. I appealed mine last year with 3 comparable home sales I found on Zillow. Took me 45 minutes, saved $840 annually. Seniors often get additional appeal windows or fee waivers. Some counties have dedicated senior appeal boards that meet separately from the general appeals. Look up your county assessor's website. The deadline is usually in the spring, and if you miss it, you wait a full year. Set a calendar reminder for January 1st every year to check your assessment. If it went up significantly and your home didn't change, appeal it. The success rate is higher than you'd think because most people don't bother, so the assessor's office isn't prepared to defend every appeal. Bonus 4, the widow's penalty. This one hurts. When one spouse dies, the surviving spouse often gets bumped into a higher tax bracket with the same income. It's called the widow's penalty, and it can increase your tax bill by thousands. Here's why. When you're married filing jointly, you get a much wider tax bracket. In 2026, the 22% bracket for married couples goes up to about $201,000. For a single filer, that same 22% bracket tops out at about $100,500. So if a couple was making $150,000 and one spouse dies, the survivor is now a single filer with $150,000 in income. They're deep into the 24% bracket instead of comfortably in the 22% bracket. The tax difference can be $3,000 to $5,000 per year or more, but you can plan for it. Consider Roth conversions while both spouses are alive, when you're in a lower bracket. That way the surviving spouse inherits tax-free money instead of taxable traditional IRA distributions. Talk to a fee-only financial planner about this. It's not free advice, but it could save you 5 figures in taxes. And do it while you're both healthy and thinking clearly. The worst time to make financial decisions is right after a spouse passes away. The emotions are raw, the grief is overwhelming, and the last thing you want to do is figure out tax strategy. Plan ahead. Your future self or your surviving spouse will thank you. Here's the bottom line. The financial industry profits when you don't know these rules exist. They profit when you overpay, when you miss exemptions, when you assume you don't qualify. The system is not designed to hand you savings. You have to ask, you have to search, you have to know the rules. Think about it this way. My grandmother lost $8,400 because she didn't know. That's $8,400 she could have used for travel, for her grandchildren, for peace of mind. Instead, it went to a utility company that was legally required to stop charging her. One conversation, one Google search, one 10-minute application, that's all it would have taken. If you found value in this, drop a comment with the word Apple. Yeah, I know, random. But if I see it, I'll heart it. And check out this video right here on how your net worth explodes after you hit $100,000. It's one of my favorites. Thank you for spending your time with me. I'll see you in the next one. Peace.